Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance, and today we're diving into Vistagen Therapeutics, Incorporated's latest report for the period ending the 31st of December 2025. Now, this company is playing in the very challenging but potentially very rewarding neuroscience space. And let's just say this report has some interesting developments and maybe a few red flags to discuss. You won't want to miss what we uncover. Before we jump in, if you love getting these clear and straightforward breakdowns of company filings, hit that subscribe button and ring the notification bell so you never miss an episode. Also, we have a fantastic community forming over on Discord. All the details are linked in the description below, so join the conversation. Alright, let's get straight into it. Vistagen Incorporated is a company focused on developing new drug candidates for neurological and psychiatric disorders. They have a pipeline of something called pherines, which are designed to work uniquely through intranasal delivery. They have several product candidates in various stages of development, notably fasedienol for social anxiety disorder, itruvone for major depressive disorder, and refizolone for menopausal hot flashes, among others. The story here is the ongoing journey through clinical trials and the significant resources required to get these drugs to market. First up, the balance sheet. This gives us a snapshot of what Vistagen Incorporated owns and owes. As of the 31st of December 2025, total assets stood at approximately $65 million. Now compare that to the 31st of March 2025, when it was about $84 million. That is a drop of roughly $19 million, or about 23% in one quarter, primarily due to changes in cash and cash equivalents, as the company spent money on its operations and development. On the other side of the balance sheet, total liabilities were about $14 million at the end of December 2025. Stockholders' equity, however, saw a noticeable decrease, falling from around $70 million in March 2025 to about $51 million by the end of December 2025. This drop is largely a reflection of the company's net loss during the period. Now let's talk about how the company performed financially. Revenues are interesting here. For the 3 months ended the 31st of December 2025, they reported sublicense and other revenue of about $303,000. This is up from $234,000 in the same period in 2024, a positive sign on the revenue front, though still very small in the grand scheme of things. However, the big story for Vistagen Incorporated is the extensive operating expenses. They reported research and development costs of over $14 million for the 3 months ended the 31st of December 2025. That is a significant increase from about $11 million in the same period last year, representing about a 26% jump. General and administrative expenses also rose to over $5.6 million from around $4 million in the prior year's quarter, about a 39% increase. Unsurprisingly, this all leads to a substantial operating loss. For the 3 months ended the 31st of December 2025, Vistagen Incorporated reported a loss from operations of nearly $19.5 million. This is up from a loss of about $15 million in the same quarter of 2024. The 9-month figures tell a similar story, with a loss of nearly $55.5 million for 2025 compared to about $41.5 million in 24. It is clear that developing these neuroscience drugs is a very expensive endeavor. The net loss for the 3 months ended the 31st of December 2025 was approximately $18.9 million. For the 9-month period, it was a staggering $53.4 million. This puts their accumulated deficit at a substantial number, meaning they have a long way to go to profitability. Looking at the statement of changes in stockholders' equity, it is important to see how these financial results impact the owner's stake. For instance, the accumulated deficit at the 31st of March 2025 stood at over $407 million, and by the 31st of December 2025, it had grown to over $461 million, showing the continued erosion of retained earnings due to those losses. The statement of cash flows reveals where the money is actually coming from and going. For the 9 months ended the 31st of December 2025, their net cash used in operating activities was over $50 million. This is mainly driven by that net loss we just discussed. Investing activities also use cash, though, less significantly, with about $778,000 used. Financing activities, however, are where Vistagen Incorporated is getting its fuel. In the 9 months ended the 31st of December 2025, they provided over $31 million through financing activities. This is largely thanks to stock sales under their open market sale agreement. This shows their reliance on external capital to keep operations running. Now let's zoom out a bit. The business description tells us Vistagen's core strategy revolves around what they call pherines delivered intranasally. They aim for rapid activation of nodes to brain neurocircuits with the hope of avoiding systemic absorption complications. This is a novel approach, but one that carries significant scientific and regulatory risk. This next part is crucial and frankly a bit concerning. Under liquidity and going concern, they openly state that they require substantial additional capital to complete development and commercialization. They have a significant accumulated deficit and expect operating losses to continue. The report explicitly states that as of the 12th of February 2026, there is uncertainty about whether their cash will be sufficient to fund operations beyond 12 months. This means they are facing substantial doubt about their ability to continue as a going concern. This is a serious red flag for investors. The fair value measurement section details how they value their cash and marketable securities. As of the 31st of December 2025, their cash and money market funds were valued at over $47 million, all categorized as level 1 assets, meaning they are traded in active markets. Their marketable securities, primarily US Treasury. Securities valued at nearly $14.4 million were classified as level 2 assets, indicating valuation based on observable inputs for similar assets. The breakdown of marketable securities by maturity shows they are holding us Treasury notes with maturities less than 1 year. This indicates a conservative approach to managing their liquid assets, focusing on safety and accessibility to fund short-term needs. In May 2025, they took out a promissory note for about $1 million related to insurance premiums. As of the 31st of December 2025, this note had an outstanding balance of around $400,000. This is a relatively small amount, but shows the various ways companies finance their operations. Here we see details about their common stock and warrants. The October 2023 public offering raised considerable capital, but also led to the issuance of many warrants. The company classifies these warrants as equity instruments. The open market sale agreement with Jefferies LLC has been a crucial source of funding, with over $140 million worth of stock still available to be sold. They sold over 10 million shares under this agreement in the first 9 months of 2025, generating over $30 million in net proceeds. This is a key mechanism for them to raise funds as needed, but it does lead to significant dilution for existing shareholders. Stock-based compensation is a significant expense. For the 9 months ended the 31st of December 2025, they recognized over $3 million in stock-based compensation expense. This is a common practice in the biotech industry to attract and retain talent, but it does dilute existing shareholders. The number of outstanding stock options has increased, reflecting ongoing equity grants. This expense is recognized across research and development and general and administrative functions. Basic and diluted net loss per common share is negative as expected given their losses. For the 3 months ended the 31st of December 2025, the loss per S-share was 45 cents. For the 9-month period, it was $1.46. The number of weighted average shares outstanding has increased significantly, which is mostly due to the stock sales mentioned earlier. Sublicensing and collaborative agreements are a potential revenue stream. The AFAMD agreement for Fasedienol in certain territories brought in around $303,000 in revenue for the quarter and $804,000 for the 9 months. They are eligible for significant milestone payments up to $172 million from this agreement. The Fuji Pharma agreement for Refizalone is still in exclusive negotiation and has not generated revenue yet, but represents a future potential deal. This section highlights potential future obligations and risks. They are currently involved in 2 civil actions filed by purported stockholders, alleging misleading statements and material omissions regarding clinical trials. These lawsuits could be costly and consume management's attention. Now, for the risk factors section, which is always a stark reminder of the challenges, they highlight that they are a clinical stage company with no approved products and significant net losses. The need for substantial additional financing is paramount, and the risk of delisting from Nasdaq due to not meeting the minimum bid price requirement is very real. Failure to regain compliance by August 2026 could seriously impact their stock liquidity and ability to raise capital. They are heavily reliant on the success of their product candidates, and the drug development field in general is fraught with high failure rates. The regulatory approval process is a major hurdle. They emphasize the unpredictable nature of getting drugs approved by the FDA and other foreign authorities. Even with positive trial results, approval is far from guaranteed. They also point out that their product candidates are considered drug-device combination products, adding another layer of regulatory complexity. Vistagen Incorporated is heavily reliant on its key management and scientific personnel. The loss of these individuals or an inability to attract new talent could significantly harm their business. The competition for skilled professionals in this industry is fierce. The market price of their common stock is expected to be highly volatile. Factors like clinical trial results, regulatory news, and overall market sentiment can cause significant swings. The NASDAQ minimum bid price issue is a perfect example of how a specific company event can drastically impact stock performance. Looking at their tax situation, they have substantial net operating loss carryforwards which could potentially offset future taxable income. However, these can be limited by ownership changes and other tax regulations, which means they might not be able to fully utilize them. Finally, the disclaimer about disclosure controls and procedures. While they have these in place, they acknowledge that no system is foolproof and errors or even fraud could occur and not be detected. This is a standard disclosure, but it does underscore that absolute certainty in financial reporting is impossible. So what is the overall picture here? The core of Vistagen's narrative is high risk, high reward. They are pursuing novel treatments in a challenging field requiring massive investment. The financials clearly show they are burning cash rapidly and are heavily reliant on future financing. The legal proceedings and the going concern doubt are serious headwinds. While they have promising science and potential revenue streams, like the famed agreement, the path to profitability is long uncertain and requires constant capital infusion. The delisting threat from NASDAQ is a very immediate concern that could severely impact their ability to raise necessary funds. In summary, Vistagen Incorporated is a company on the frontier of neuroscience drug development. They have a clear strategy and important clinical milestones ahead. However, the financial realities are stark. They have significant operating losses, substantial accumulated deficit, and a pressing need for more funding to continue their operations. The success of their clinical trials and their ability to navigate regulatory hurdles and secure additional financing will be absolutely critical to their survival and future success. The market is watching very closely. Alright, that is our deep dive into Vistagen Therapeutics Incorporated's latest filing. What do you think of their chances of success given the risks in their current financial position? Let me know your thoughts in the comments below. If you found this breakdown valuable, give this video a thumbs up and subscribe for more corporate analysis. And don't forget to join our growing community on Discord linked in the description. Thanks for watching Corporate Decoder, and we'll see you in the next one.